the sector diversification has kind of moved up a tier to the LP level. They're much more willing to be the ones kind of deciding what their sector diversification needs to look like and choosing the specialists that are going to get the best returns within that sector.
What common mistakes do you think first-time or emerging managers make in setting up fund operations?
Whatever you establish on day one, it's hard to pivot from that. And investors, don't want to be the ones, investing in the pivot, let's say.
What characteristics consistently differentiate top-decile performing funds from their peers?
I would say that adherence to strategy is one of the key kind of underlying themes that we see on the top performing funds.
What changes have you seen in how fundraising is approached post-pandemic, and what's working now?
I'd say the biggest shift is it's become much more of a numbers game at this point for managers. Like literally having hundreds or thousands of conversations to go out and raise a fund.
Hey everyone, this is Prashant and I'll be host for the VC 10X podcast. And today we have Braughm Ricke with us. Braughm is the founder of Aduro Advisors, a firm that has a bird's eye view of the industry that few can match. With over $131 billion in assets under administration across 650 plus firms, they are seeing the real-time shifts in valuations, LP behavior, and fund performance. We dive into why fundraising has become a numbers game and the specific traits that separate the haves from the have-nots in today's market. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast 10X, where I help venture capitalists, asset managers, allocators, and family offices in starting their own podcast and building a strong brand. Podcast 10X is designed in a way to work well with the busy schedule of investors, where we handle every aspect of podcast production so you can focus on investing. If you're looking to build a strong investor brand, starting a podcast should be right up your priority list. It's the only form of marketing where you can showcase your strong network, in other words, access to limited partners and founders, and grow that network further. And contrary to what most people hear, it's still very early to start a podcast. There are at least 10x more newsletters and 1000x more blogs than there are podcasts in this world. You can learn more about our podcasting services at podcast10x.com. I'll make sure to add the link in the description below. Enjoy this episode. Hey, Braughm, so good to have you on the VC 10X podcast. How are you doing?
Good. How are you? Thanks so much for having me.
Yeah, it's a pleasure having you on. To start things off, can you tell us what inspired you to found Aduro Advisors and what gap in the industry were you aiming to fill?
Yeah, I always kind of liken this back to actually the decision that I made to join True Ventures at the outset when when John and Phil formed that organization all the way back in kind of late 2005, early 2006. At the time, we were really talking about the next generation of platform VCs kind of coming to fruition during that time period. And that really resonated with me. And so I decided to make the leap to join that team. Fast forward around 7-ish years from there, and started to kind of see another shift happening in the marketplace with more and more individual managers starting to spin off and kind of raise their own funds, more entrepreneurs as opposed to successful entrepreneurs as opposed to going to a large VC platform, choosing to raise a fund of their own. And inherently, during the time frame as well, starting to see a shift towards more access to capital. Obviously today is quite different than it was 12, 13 years ago, but certainly a major shift in access to capital, access to LPs in general there. And so really thought that it would be a great time to kind of consider building a firm somewhat dedicated to supporting the broader emerging manager set. Right. And that has definitely grown exponentially from there. But that was kind of the original genesis of why I chose to set out on this path.
Absolutely, quite interesting. And based on your work with hundreds of VC and PE firms, what major shifts are you seeing in fund operations over the past few years?
So a much greater focus on data and the flow of that data, kind of as we start to see an exponential growth of number of managers, as we start to see an exponential growth of number of investors within this asset class. Ease of data movement, I think, is quite critical. And, kind of that really, resonated when I started the firm, looking at all of the off-the-shelf technology that was available, and kind of, going through that exploration of, do I, try to leverage off-the-shelf technology, or do I think about kind of embarking on our own technology path. And kind of early days, we chose to really explore heavily building out our own, which we've now been quite successful at building out the fundpanel.io platform. And that really does help us kind of facilitate that data flow. But I think looking ahead, as we start to see a greater shift of investors within the alternative asset class in general, I think that data flow and the ease of data movement, not just within, kind of the universe of, our system or anybody else's specific system, but the movement of that data externally to other systems and making it much more portable. And I think it's going to be critical, as more and more people are stepping into this asset class.
Absolutely. And you sort of have a bird's eye view on the venture landscape and how fundraising is happening when it comes to raising from limited partners. You're working with over like 140 plus firms and uh, managing, correct me if I'm wrong on any number, by the
100,
way.
140 billion. Yeah. So, yeah.
Yeah. So yeah, assets under administration is 140 billion, and I mixed up the two numbers. And yeah, a great hundreds of clients as well, right? So with that kind of client data set, what are you seeing? And I know you published your Aduro report, which has recently shown stabilization in fund performance after the 2023 market corrections. So do tell us what you're seeing now and what factors do you think contributed to the recovery that we are experiencing now?
Yeah, having been in the industry for quite some time, I started my career in venture in fall of 1999. So I've seen multiple, kind of cycles. Let's say one can say crashes as well, but multiple cycles. And each one is different in terms of the longevity, the length, the reasoning as to why. Um, but really starting to see that play out, that stabilization play out, as you mentioned in our data. And I think what is interesting is we have a total of 650 firms that we work with today, as you mentioned, 140 billion in assets. So it really does give us a very interesting purview from a data perspective. And again, going back to kind of our data structure and having our own proprietary technology, it enables us to kind of cultivate and centralize that data in a quite efficient mechanism and manner. And so we're able to really kind of look deeper into that and into that information and that data for the benefit of ourselves, but for the benefit of our clients and for the benefit of the marketplace as a whole. And really, it's a data set that not others really have access or purview or kind of transparency into. It's a very opaque industry still. And I think that transparency will be, kind of critical again, on a go forward basis, kind of going back to that data commentary. But what we've seen is really kind of that run up in valuations in the, call it 21 to 23, 2021 to 2023 timeframe, when very active, lots of companies could go out and raise money at significant valuations, a lot happening in the later stages of the venture market as well, in the kind of the growth equity category. And so really kind of saw that take hold within the numbers themselves. And you see a pretty significant spike in the numbers in 2023. And kind of 2024, it feels like it kind of everything came back down to earth to a certain extent, from a valuation perspective. And venture is pretty good at reacting to the overall kind of market dynamics and market environment. And so we saw that happen, fairly rapidly for venture, much more rapidly than maybe I've seen it in the past, even, despite the fact that most of these companies are, still being held privately and not really kind of, mark to market, the way that we think about it from a public equity perspective. And so, 24 was interesting with that dip down, and then a lot of stabilization from there, right? So, like, I think we hit the trough per se, pretty quickly, and we're starting to see now the kind of the rebound associated with that. So, not in a significant way, we're not seeing a spike kind of back up and to the right, but we've definitely not seen any further kind of decline, if you will, of market valuations.
Absolutely interesting. Uh, how have fund sizes and LP composition evolved, and what does that mean for managers raising in 2025 and beyond?
Yeah, I mean, if you look back at, especially when I started this firm, there are thousands, literally thousands more venture firms today than there were when I started. And so inherently, um, that means, yes, there's more capital in the market, absolutely, but there's not so much more capital that the fund sizes haven't decreased just naturally. And so, fund sizes are much more targeted. I would say strategies are much more targeted. And in general, you're kind of leading to smaller fund sizes and kind of more right-sized funds, if you will. And I think there's been a significant recognition of the value in a smaller fund size, inherently of, what that could mean from a returns perspective, how much, not necessarily easier, but how much more rapidly you can return a fund that's 100 million versus, 500 million, right? And kind of what the wins need to look like within that portfolio to facilitate that. And so, historically, at prior firms that I worked with, we used to look at a deal and say, okay, it's going to be a great deal if it can return, at least half of the fund or at least 1x the fund. I think that we've gotten far away from that, but I think these follow smaller fund sizes help us kind of get back to that a little bit.
Yeah, absolutely. And what common mistakes do you think first time or emerging managers make in setting up fund operations?
I liken the mistakes a lot to deciding what you want to be when you grow up. And what I mean by that is, if you're setting out to be a fund manager that's going to build more of a platform or a franchise, if you will, that's going to kind of continue on. Know that on day one, and or at least have an idea, an inkling of that on day one, and figure out what structure you want to establish from day one, because whatever you establish on day one, it's hard to pivot from that. And investors, don't want to be the ones, investing in the pivot, let's say. And so kind of making that decision early on. So do you want to build a platform, or do you want to, be a deal by deal investor, for the foreseeable future just on your own? Or do you just want to, the franchise is basically yourself and then you'll wind it down thereafter, right? And so I think making that decision and kind of setting up a structure, I think a lot of funds have come out and said, we're going to do SPVs and, first to kind of test things out, and then we'll go and raise a fund. That's a hard pivot to make. It's not impossible, but it is a hard pivot to make.
Got it. Yeah, that's useful advice for fund managers there. How important do you think is sector diversification versus specialization for top performing funds, especially from the perspective of LPs and how they are viewing things?
Yeah, I think going back to my earlier statement about the shift in venture and the venture marketplace and what it looks like today versus what it looked like historically. Historically speaking, when the emerging manager trend really started to take hold, I think a lot of large institutional investors didn't necessarily know how to invest in that type of market, or want to, right? So they were kind of standing back and kind of watching it from afar to a certain extent for the first bit there, because historically speaking they would say, okay, I have enough room to add, two new managers to my portfolio at a total of, 15 managers, or whatever it is. Everybody kind of has internal targets for that, and they didn't know how they would go and, add 10 new managers because of this new emerging manager category. I think that has evolved, and a lot of the kind of strategies associated with that from the institutional investor side of the equation has evolved as well. And so they're much more willing to, um, as opposed to the individual venture manager being the one to diversify on the sector level. I think the sector diversification has kind of moved up a tier to the LP level, right, to a certain extent. So they're much more willing to be the ones kind of deciding what their sector diversification needs to look like and choosing the specialists that are going to get the best returns within that sector. And I think that focus on a specific sector or segment or area of specialization, I think that's one of the key differentiators that a manager can bring to the table, especially if they have experience within that subsector, whatever it is that they're focusing on. And I think that will only be, kind of more important on a go forward basis, versus kind of sector diversification. If you look naturally over, even the course of my career in venture, we've gone from all the way from a one fund being not only sector diversified within technology, but sector diversified, half life sciences, half technology, to now where we're at today, where, focused on one specific subsector within technology.
Absolutely, that's quite interesting. So, from what you're seeing in your portfolio, are you seeing that majority of the new managers are trying to have a specific sector focus based on their background, and there are no generalist firms out there? And if they are they struggling more to raise versus the sector specialized ones?
I think there's always going to be an area or a room rather for both in the market, both a technology generalists, as well as ones that are specialists. And I think that a lot of it depends on what their background is, the managers themselves. If they come out of a specific sector where they have a great deal of expertise that they can bring to the table, and that's one of their big value propositions. And then clearly focus on that would be relevant and important. Somebody like that going and becoming a generalist doesn't make a lot of sense, right? And so I think a lot of it is tied back to the people themselves. And not necessarily just one sector, but one classification. Do you just focus on consumer technology versus enterprise, and vice versa? Do you just do enterprise technology versus consumer? Or there are firms that, and those are somewhat generalists, right? So like generalists in terms of consumer and generalists in terms of enterprise. But then there are groups out there that are, they specialize on one specific sector of consumer or one specific sector of technology. So I think just with the sheer number of managers there are out there, I think there's going to be a quite bit of variation, in terms of those structures. I think that in general, I would say that a generalist is going to be slightly harder to raise money because you're selling less of a differentiation, unless you're, a big, well-established firm where, kind of everybody is going to be, you're still going to get the deal flow that you need to have to be successful at the end of the day. As opposed to if you're specializing in one specific market, you have a great deal of expertise. Of course, you're going to be one of the first to see the best deals within that subsector that you're investing in.
Got it. Yeah. And talking about the Aduro Advisors Q2 2025 report, are there any surprising findings in there about performance trends for small, mid-size, or mega funds?
Yeah, I would say the not necessarily surprises, but I think what's been interesting to see in our data is uh, data proving out some anecdotal items that we used to speak to in the past, such as um, investing 100% or more of the fund. We would always, I would always recommend and advise managers to try to invest as close to 100% of the fund as possible. We would always, tell them that the LPs would want to see that, the investors want to see that. But we've seen, kind of data play out that shows that those tend to be, more successful, at the end of the day, the ones that do that, right? And so, it's nice to see kind of data supporting the kind of anecdotal advice that we've given in the past. It is a nice surprise to see um, that return to positive returns, if you will, on the IRRs in general, and seeing that kind of play out. But I'd say one of the biggest surprises is now that because we have all of our data and we're the source data, we can kind of drill down into additional layers within that data set and start to pull out some more interesting insights. And one of the interesting insights that we recently took a look at with this most recent report was the number of institutional investors versus individual investors within our specific client set, which I think is quite representative of the overall venture market. It's been really interesting and a bit surprising to see the sheer volume a shift towards the individual investor, um, within the asset class that we kind of focus on or have had the bulk of our client work kind of stemming around. Because if you think about, 10, 15 years ago, if I was just walking down the street, even in San Francisco, and talking to somebody and I said I work in the venture capital industry, half the time in San Francisco, they would understand what I'm talking about. Anywhere outside of San Francisco, it's like 20% of the time. Now I think I could walk down the street in, um, even in the Midwest, and talk about venture capital, and many people know and understand it. So I think that just the understanding of what this asset class is and what it means has gotten much more pervasive across the entirety of the high net worth individual, kind of category. And so there's a lot more individuals participating. I think that we'll see that trend continue, especially with the changes in the regulatory environment.
Absolutely. And what are you seeing on the longevity of a firm, right? Because a lot of firms, especially in the climate that we have seen in the past 3, 4, 5 years, have not been able to perform well or show the returns or the liquidity in their portfolio and have fizzled out, unfortunately, right? So, are you seeing some of that within your portfolio as well? That firms are struggling to stay afloat or raise subsequent funds because of that?
One thing that we've always focused on, when thinking about the firms that we're going to work with, and by no means are we, perfect at this in any way, shape, or form, but we've always had a greater focus on quality versus quantity within our client base. And so, interestingly, Q1 of 2025 was one of our busiest quarters, from a existing client growth perspective, than we've seen historically. And so it's a really interesting dynamic to see, how much activity there is within our client set. And I think that what that illustrates is really kind of the overall dynamic in the venture market, which is what I call like the haves and have-nots, right? And so I think that there's this big separation or big segregation of the haves and have-nots within the venture marketplace, within the venture, kind of manager set. And I think that that's only gotten larger, over, especially the last handful of years, as we've seen this downturn, that the chasm between those two has gotten even greater. And so I would say like the haves are always going to be able to raise, and they're going to be able to raise time and time again. Obviously, they have the performance associated with that, but then there's other kind of dynamics from a relationship perspective, a network perspective, et cetera, kind of their backgrounds. Um, but I think that people stepping into the market, unless they have kind of something specific that they can point to that's quite significant, of quite significance, I think it makes it very hard to go out and raise capital. So we've definitely seen less of that within our specific client set. We've talked to a lot of groups that have kind of hit a virtual wall, if you will, and from a fundraising standpoint. And I think that there are a lot of managers out there that are kind of recognizing the fact that maybe this isn't a category for them, maybe. And so I think that there will be quite a bit of secondary activity. We're hearing a lot of secondary activity on liquidity, number one, but I think that we'll see a lot of secondary activity with regards to, entire, not necessarily firms, but entire portfolios or entire funds, so that they can kind of, park those somewhere where they can go off and kind of, shift careers, if you will.
Yeah, absolutely. What characteristics consistently differentiate top decile performing funds from their peers?
Yeah, so going back to those kind of have and have nots, right? So, who are the haves and who are the haves that have that top return profile? Uh, I would say that adherence to strategy, is one of the key and kind of underlying themes that we see on the top performing funds. And what I mean by that is not necessarily adherence to a portfolio fund model or anything like that, but again, if your strategy is this one specific sector um, within a category, adherence to that strategy, adherent and focus on that. Or if your strategy is like you're going to be, one of the first institutional money in the door, don't suddenly start doing Series D or Series B or Series C deals, right? And so I think adherence to strategy and not kind of getting pulled in different directions. Again, venture in general is fast moving, and there are a lot of ways to get pulled in various directions. I mean, let's just look at, how quickly AI has become, the investment theme for, almost everybody at this point. Um, and so I think that adherence to that strategy is key. And then also, a very specific point is what I mentioned earlier, which is that kind of investing as close as possible to 100 or 120% of that fund, right? And so just trying to maximize not only the shots on goal that you have within a specific portfolio, but how much of that portfolio company you have at time of exit from a percentage perspective and ownership perspective. Um, and really recognizing that, you know, being able to recycle some of the, kind of earlier dollars that you had to pay out for fees and reinvesting that into the portfolio not only does it give you kind of more exposure to that portfolio in general, but it also gives you a little bit more of a time diversification as well. So, a great example is like if you put, money into one of your portfolio companies in 2022 or 2023, they came back and had to raise in 24 at a lower valuation. You want to re-up in that company because despite the market dynamics dictating that it's at a lower valuation, it's still a good company. It's still going to have a successful outcome. So you want to, be able to be in a position to protect that and to reinvest in that.
Yeah, absolutely. And let's talk about your platform, Fund Panel, right? How does it help streamline fund administration and improve reporting for clients?
Yeah, I think that what was, kind of evident, like I said when I set out, was kind of the need for a platform of our own to inherently enable us to service this portion of the market effectively and efficiently, but then also ensure delivery of data in a rapid and streamlined fashion. And so I think that's one of the big kind of key components of our platform is we are not having to kind of create the data and then go and push it out to a portal or create the data and then go and upload some separate set of data into the portal, etc. The portal that we have today, which has about 100,000 unique users on it from an investor perspective, it's looking at live source data that our team is creating within the system directly. So for our team to expose information out to our clients' investors is just a check of the box. It's not, having to think about anything beyond that. And so that speed and efficiency of that information delivery has been extremely beneficial, and I think is becoming expected within the overall market as well.
Yeah, absolutely. What role does AI play in fund administration today?
Yeah, I think AI. To me, AI is you're going to play this as a very similar role as technology does today. Yes, it is another form of technology at the end of the day. And what I mean by that is it's an efficiency tool, just as technology is. And so one of the reasons that we set out to build Fund Panel is we wanted to make our team more efficient so that we could better service, kind of clients of the size and scale that we service today. We are, of course, going to absolutely tap into AI as much as we possibly can to, expand that efficiency and expand that benefit that we have utilizing technology. And when we think about our technology, the way I think about it is Fund Panel effectively has three main customers. One obviously being the GPs themselves, the managers that we work directly with, but also secondarily the investors in those venture firms, the LPs. They're absolutely a customer of our product and of our technology. Um, and then our team, our internal team. So they are absolutely a customer of our software. And so leveraging AI in all three of those categories for efficiency, um, data discovery, information discovery in a more rapid way is going to be critical. And so that's how we're looking at it at a high level. How we're deploying that is, again, AI powered discovery on the investor portal so that investors can come in, find their information more rapidly. It's very intuitive for them with a handful of clicks to get to the information that they're looking for. But why should they have to do those clicks anymore? Right. So using AI to pull out and extrapolate the information that they're looking for. Same with our team. They should be able to quickly and more easily find all of the information that they're looking for. And we're doing that internally with our internal systems. We're doing that within Fund Panel for our systems as well, for our clients' data, and then our clients as well. Kind of really powering all three of those categories with AI as much as we possibly can. But then taking it a step further, that's great from a discovery perspective, but what more can we do, with that data, going through these models, and thinking about the logic that we can apply on top of that. And so thinking about, placing that logic on top of our data we shouldn't necessarily have to be the ones to say like, oh, here are the interesting insights coming out of our data. You should be able to come in and use AI logic to say, okay, like what are the interesting insights, right? And it should go and extrapolate those out for you. Same with our clients. They should be able to go in and, look at their data, and, pull out insights, pull out trends, pull out, interesting information within their data set, but then also model that out for themselves, right? And so really to me, it's going to, kind of level up our team as a whole and level up our service capabilities, because a lot of these things that we're having to do, kind of behind the scenes, or we're having to put more, kind of emphasis or thought or time into, really become much more automated with the usage of AI.
Absolutely. It's a massive efficiency tool for everyone. And what changes have you seen in how fundraising is approached post pandemic and what's working now?
So early days of starting Aduro, like I said, it was still very relationship based in terms of fundraising, right? And so kind of tapping into existing networks, existing kind of relationships that you had with investors or LPs, whether they're institutional or high net worth individuals, etc. I'd say the biggest shift is it's become much more of a numbers game, at this point for managers. Um, like literally having hundreds or thousands of conversations, to go out and raise a fund. And so it really is, just kind of getting introductions to anywhere you can to try to tap into capital. Obviously, there is going to still be a big, kind of relational aspect. This is absolutely, a heavy relationship industry, both from a venture asset class investing in startups, but then also the investors, the LPs themselves investing in the venture firms. Always going to be a relationship aspect, but I think that it's become much more of a numbers game, especially as we're started to see the prevalence of, individual LPs, in the market. And there are firms out there that are trying to tap into this. Like a good friend of mine over, Samir over at Allocate, right? Like trying to kind of, create some structure around that world. And so I think that we'll start to see, much more of a shift towards individual, much more of a shift towards, just pure numbers from a, kind of a fundraising pipeline standpoint.
Absolutely. That's quite insightful. And moving to our last question before we try to close this out, where do you see the biggest opportunity for innovation in fund operations in the next 5 years?
I would say that tools and utilities around supporting that shift towards individual investors. So it's a really good kind of segue into this question. Um, you know, I think that as we shift more and more, not necessarily away from institutional investors, but much more of a blend, with an even heavier focus on the individual investor coming into the venture asset class. Um, Tools to deliver their information, tools to make data, more portable, as I was saying, right? And so individual investors, they shouldn't necessarily have to come. I would love to have them in the fund panel portal. They shouldn't have to come into the fund panel portal. They should be seeing that information on their, their wealth managers, platform, whether that's Adapor or anybody else, right? And so we should be able to flow that data wherever. So we should be somewhat more agnostic, and a hub at the same time. And so I would say that, kind of being at the centralization of that and being able to help facilitate that is core to our belief and kind of where we're going. But I think it'll be, kind of instrumental in how we think about, the future of the infrastructure that kind of powers, this part of the asset class.
Yeah, absolutely. Completely agree with you. Uh, so, with that, we come to the end of this conversation. Do let our listeners know where they can learn more about Aduro Advisors and your platform, Fund Panel, and follow your journey.
Yeah, absolutely. So, yeah, aduroadvisors.com. If you want to find information on us or our services, feel free to reach out. You can contact us there on the website. Fundpanel.io is our technology platform. That is our investor portal. We're really proud of, kind of both sides of our business, both from a services and technology perspective, and they are very intertwined, both support one another. And yeah, very much appreciate you having me on today.
Yeah, it's a pleasure. Thank you so much. I wish you all the best.
Thank you again.